Good morning. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital. I'm excited to be joined by my longtime friend, industry colleague, well-known REIT analyst, Alex Goldfarb. We have several slides that we'll go through. We'll turn off the presentation. We'll refer back to it a couple of times, as there's some great material that Alex and the Piper Sandler team have shared with us. Before we kick this off, we have been asked to show a handful of disclosures and disclaimers on behalf of Piper, so we have it up on the screen here for your review. And there's a lot of interesting, timely stuff to talk about here, especially looking at his coverage universe and some of the different names and things that are going on in the industry. These are more Piper Sandler based company disclosures that they have asked us to show as well.
Thank you, Dave, for
For
making
those that
thank you for making our compliance department happy and our director of research. We appreciate it.
all about compliance, my friend.
Exactly.
For those that don't know Alex, he is the managing director and senior research analyst at Piper Sandler, coming over prior when it was known as Sandler O'Neill. Deep experience working at shops such as UBS and Lehman Brothers. And I'm sure we could do a huge conversation just on Lehman Brothers alone. And he went to Wheaton College in outside Chicago. Interesting. Got a lot of friends and family that know that.
Actually, there are two Wheatons. One is a conservative Christian school. The other is quite a liberal arts school outside of Boston. So they're sort of on the antithesis of the spectrum. I went to the Massachusetts one.
We're 2 minutes into this and I'm already being corrected. That's great. So we're going to jump right into it because right now, with what's going on overseas, the REIT sector has kind of done a round trip just over the past few weeks. We had a nice run up until the conflict started. We're giving it back. 10-year Treasury currently at 4.3856. Before you get into it, though, one thing to note for those that are watching this today or on the replay, today is a very special day in the REIT industry. And though you don't cover the name or its peers yet, we had the pricing IPO last night of Janus Living, the Health Peak spinoff, ticker JAN, was emailing the CEO this morning. Heard the deal was 14 to 15 times oversubscribed, priced at $20. Early indication is $22 to $24. Maybe it will open before we get through the end of this presentation, but it's very interesting to see that activity is alive in the REIT industry, regardless of sector performance or overseas macro issues that are going on. And we'll talk some more about that. But Alex, you have this great table that you shared with us talking about performance basically over the past year as well as year to date. What can you talk to us about REIT sectors and individual stock performance so far this year?
Well, first, thank you, Dave, for having us on. It looks like we have some other people who are joining us. So one, appreciate, great to speak to your audience, and you've certainly done a phenomenal job of taking over as the inside juice, if you will, in REITland. So it's awesome.
I'm no Barry Vinokur, but thank you. I appreciate that.
Well, you've interviewed a number of REIT CEOs on your different, if I can call these podcasts, and I think you definitely have added a great element that REITland was sorely missing, and you've now supplanted. So that's awesome. If we go back to the start of this year, REITs had underperformed the broader market for several years, and it was almost sort of a a give up trade, if you will. This year, yes, we started the year with a really wide valuation, but as we all know, valuation never in and of itself is enough. But the right qualities came together and REIT started to outperform. Yes, they're off, as of last night's close. I have the group up about 6% year to date. The S&P is down about 3.5%. So for a war in Iran and the Straits of Hormuz closed down, that's not such a bad outcome. I don't think anyone would have expected that. Yes, the 10-year is up now. For a while, it was sort of in that 415, 420. I saw on the screen it was closer to 440 this morning. The 10-year will bounce around, but in general, for some time, it's really hemmed between 4 and 4.5. And the credit markets remain incredibly durable. So unlike the equity markets where there's a tremendous amount of fear priced in, you speak to any of the REITs that go out with a bond offering, and it's been phenomenal. You mentioned Janice. I don't cover the senior housing space, but clearly that's been a sector that has been hugely in demand. I don't know if that's a good thing or bad thing, given at some point all of our numbers will be up, and we'll all be looking for some senior housing. But the point is that when you look at real estate today, and this has been a theme that we've been talking about for quite a few years, is that unlike any other period in the past 50, 60, 70 plus years, we really have no new supply. And every other cycle, we have had a tremendous amount of overbuilding, too much capacity, or some sort of financial crisis. Right now, we have none of that. And when you look at what inflation has done to replacement cost, when you look at where rents would have to be to make new development work, when you look at the restrictions on banks for lending and the amount of capital reserves, when you look at the challenges of entitlements, and we can go down the list, nothing new in any material sense is going to be built for probably the next 5 or 10 years, depending on which sector you're talking about. Apartments maybe earlier, office retail later. But the point is, we're in this window where we really do not have any new supply in a meaningful way. And that's something that I think is underappreciated by, REIT investors, or I should say the broader market. And certainly when you look at office, and I'm sure we'll get into this with AI fears, nothing new is being built for the next 5 to 10 years. And when you think about replicating what happened in malls, where you went from, didn't matter if all these malls closed down, it matters what happens to the key ones. And we're seeing that with office, that demand for well-located, highly amenitized, which is not seeing new competition, that drives pricing in such a way that, again, we've never experienced it, so the stocks aren't going to reflect that. But that's the magic that we see going forward over the next several years in REITs overall.
You briefly mentioned, and I can throw a fish reference about the 10-year treasury bouncing around the room. But in all seriousness, with it trading around 440, as you mentioned, up until the conflict had started, the credit side of the equation, the lending, as I like to say, the lending window was wide open. REITs were raising tens of billions of dollars of fresh capital. Where do you think the 10-year needs to get back to for that machine to potentially turn back on?
So, I'm not a debt guy, I'm an equity guy, but it is amazing every time REITs come to the market, the books are widely, over covered. Credit usually, the spreads usually tighten, and the deals get done. I think the REITs in general have been pretty good about timing, when to issue, and looking at the curve, looking at where rates are, looking at what's going on with Fed action and policy. Uh, and also, again, it's interesting. Uh, there are a lot of benefits of being on the private side, right? Namely, you don't have to deal with people like me and deal with like these volatile daily marks. But the benefit of being on the public side is the ability to call your bankers at basically 8 a.m. in the morning and say, I want to raise $500 million or whatever the number is. And by 4:15, you're done. That's an amazingly efficient avenue. And regardless of people's concerns about inflation, the bid for REIT credit is just pretty impressive. And whether that's a consequence of just more favorable covenants that REIT bonds have, and even if it's not the current ones, it's legacy ones that sort of make a REIT higher credit than the rating would say, or it's just the fact that people need yield, and REITs are pretty stable when it comes to that. That's pretty impressive for the durability. Again, when you look at the equation, usually it's the equity guys who are the most enthusiastic, and the bond folks who are the most nervous. And right now, it's sort of like the inverse. The equity guys are the most nervous, and the bond team are like the most aggressive. And that's a dynamic that's persisted for quite some time. To us, it should invert at some point, or at least equity, should price in faster growth. But for right now, it's why REITs are really attractive. But at the same time, you could have said that, 10 points ago, 20 points ago. I mean, the problem is that until this year, REITs had been lagging the broader market, and it was just hard to gain interest. Now that REITs are outperforming, and obviously we still have, close to 10 months left on the year, we'll see what happens. But so far, it seems like the group is holding in there.
So let's talk some more about some of these sectors and stories that stand out. You were interviewed on CNBC a couple of weeks ago. I think I was the first person that responded after seeing you on air. But you had a great note that you published looking at Manhattan office leasing, and I'm sharing the screen here showing this table. So maybe walk us through this as well as some of the other stories like AI and some of the other things that are jumping out to you. Oh, one other point I'd like you to hit on. You put out a note that was picked up. We saw a headline this week regarding semi-annual earnings reporting, extending the earnings cycle instead of quarterly reporting, breaking it out, which is obviously, I think, is, as you mentioned, going to be good for our industry. So you walk us through a couple of these different things.
Sure. So, we'll start with the AI. A decade ago, we saw this with retail. Amazon was going to kill every mall and shopping center. People were just going to sit on their couch and never go to a store again. It took COVID to disprove that narrative. Again, we saw at the depths of, or at the height of COVID, kitchen tables were going to supplant office buildings. That didn't happen either. And in fact, when you look at layoffs, generally it's the people who are not in the office who are getting laid off. So we go back, and I think one of the slides that you have that we sent you shows that if you look back over the past 35 years of technological innovations, it's outstanding how much the world has changed in the past 35 plus years. I mean, people forget we went from having no internet connectivity, no email, no cell phones, to suddenly everything is at our fingertips on a phone. People think of AI as replacing everyone, and yet if you look on Wall Street, all of our jobs were supposed to be outsourced to Texas or India, right? So the point is that technology, whatever the innovation is, whether it's the assembly line, whether it's the ATM, or whether it's uh, uh, you know Google, the cell phone, what have you, we have more jobs, not less. And it's one of the charts that is in that deck where you see over the past 35 years, all the major REIT using job areas are up, even retail. While it underperformed population growth by about a half, it's still up. And if you think about what happened in retail, I think it's one that has a table grid on it. If you think about one that has everything that's gone on in retail, where we went from full service to kiosks, department stores went away, and yet retail is still up 14%. That tells you how durable job growth is. So when we look at AI, we don't see it replacing, white collar jobs. Certainly there will be disruption, but the innovation that is created from it, the productivity gains is incredible. But let's face it, there's no one out there who says, yes, whatever you read on the internet, you can trust. So there's no reason to think that because AI spits it out, that it's correct. You still need experience, you still need expertise. And when you come to this slide on office leasing, the only way that you grow in your career is by working around other people, right? And even if you say, well, I'm an isolationist, I'm going to, be a book writer, I'm going to be a carpenter, you only learn those skills by working with other people. And the best place to do that is in the office. And whether it's the younger generation or the older generation, we are a social bunch. We learn from others. And the only way that we excel is in that process. I mean, take a look at Elon Musk. The guy apparently sleeps on the factory floors, right? There's someone who's cutting edge of genius. If he was that good, he'd be doing it on his own, right? But in essence, all the stories you read about him are how engaged he is with his people, right? That's something that comes from working in an office building. And again, I go back to this lack of supply. I think what we've all learned is if you have a choice between huge amount of demand or lack of supply, go lack of supply. Huge demand is going to drive new supply and new construction and swamp rents. But if you have lack of supply, you don't need that much demand growth to drive rents. And lack of supply is what we have right now. And that's something that, as I said earlier, we have really never experienced in the way that we have it right now. And that's an amazing thing.
Mark Holliday, this CEO of SL Green, was on CNBC recently highlighting the leasing in New York. Bloomberg ran a story yesterday talking about AI office leasing in New York. SL Green put out a press release recently, One Madison fully leased. They did this deal with Harvey AI. And you made an interesting comment on CNBC that's kind of resonated with me. And I don't want to mince your words. So I might ask you to phrase it the way that you said it. But you said something to the effect of the biggest demand of office lease right now is AI users, and we fear those are the people that are taking over our jobs. Like you said something along those lines of, isn't it kind of ironic that the fears of taking over our jobs happens to be the biggest demand for office leasing in New York right now? What was it you said exactly?
You got the basic gist, but it is that when you look at the rebound in San Francisco, when you look at the demand that like Anthropic is taking for space, it is remarkable that the very companies that are developing the very product that everyone thinks is going to put everyone else out of employment are just voracious in the consumption of office space. Uh, Last year when we visited the Bay Area in the spring, it was all AI was just about small little tenants, you know, not very big space, not enough to really move the needle. In less than 12 months' time, that narrative has completely changed with the reality that these tenants are taking more and more space. 1 in 10, and this was a stat, I forget if it was one of the REITs definitely mentioned it, but I think it's something along the lines of 1 in 10 college grads comes to New York, and I'm sure you can go on Grok or ChatGPT and double check that. But I think it's something like 1 in 10 college grads comes to Manhattan or Brooklyn. And that is an amazing source of fodder for companies. That's why they continue to locate in New York. It doesn't mean they don't locate elsewhere, but it means they locate in New York. New York has definitely cemented itself as a tech hub. So San Francisco remains the pinnacle, but New York is usually in that, when you look at VC funding, it's definitely in the top five. And sometimes, will be the top, the number three or, recipient. Depends on, when the ranking is done. But the point is that tech needs people in the office. When you look about some of the biggest sort of whip crackers on getting people back, it was the tech companies. They were frustrated that their people were, living in Idaho or had moved to Denver or wherever they were. They wanted people back in the office, right? And when you look at the overhiring that occurred during the pandemic and where the cuts have been, and you speak to people like Essex or others that are West Coast focused, they'll always comment that, yeah, the layoffs really are not in the mothership. It's more out in the tertiary markets or the people who just, did not come back to the office or were hired remotely and never came to an office. So, I think the old adage that, if you're not at the table, you're on the menu is true. And when you look at tech, the voraciousness is incredible. And yes, tech does have a tendency to overtake space. We saw that in the dot-com. It took a long time for that to unwind where all that excess space was taken. We saw that this cycle where, the big Metas and Googles and all those big companies had taken too much space. They were still right sizing. But when you look at the companies that are growing now, it's pretty apparent that people are in growth mode. And that slide that you showed on New York's resiliency, defying that all jobs would move to Texas, that everyone would work remotely, that no one would ever come back to Midtown, it's pretty remarkable. But again, the key part of that is lack of supply. And that's a point that cannot be stressed enough. So when you combine lack of supply with any amount of demand, that makes for wild things to happen. And those wild things in Manhattan are rents now for Park Avenue at 150 plus. That's a level that has never been seen before. Usually we get up to 120, a bunch of new development happens, rents go down to the upper 80s or so, wash, rinse, repeat. Now rents are just continuing to move up. We're on the cusp of getting NOI margin expansion, right? That is remarkable. Again, people aren't pricing that in, but we are all social creatures. And I'm old enough to remember when the Concorde was supposed to kill the ozone, styrofoam was going to kill the planet. We were going to have global cooling, global warming, self-driving cars. Everyone thing was going to be windmills, and the list goes on. None of that happened. What did happen, though, is there were incremental changes along the way. And net, we have more people in jobs. We take technology, it solves certain issues, it increases productivity in others. Yes, it does displace certain areas, but as I like to quote from Jurassic Park, life finds a way. And ultimately, new companies, new jobs, new products are created. That's the beauty of technology. Whether you love it or hate it, we all respect it because it's made our lives much better. We can have a debate about social media and has that been a positive or a negative? But I think we're all stewards of history to remember that, the Spanish-American War was as much started, in the harbor of Havana as it was, started in the newspapers in Manhattan that ginned up a lot of anti-Spanish vigor. So my point is that fear is tremendous. That's where we all go. The reality is quite different, and that lack of supply is truly remarkable, and it's not appreciated.
Let's shift gears just a little bit. You mentioned year to date, we're at here where the REITs have outperformed the S&P by about 10% or so. Obviously, that's changed over the past couple of weeks with this conflict. I know you're not a genie. You don't have a magic lamp or a crystal ball that'll tell you what's ahead, but how do you feel about our sector should this conflict be extended?
So I'll say this: no one is pricing in the Straits of Hormuz opening tomorrow, right? And I think we would all agree what will happen if they open tomorrow. People, yes, Trump is a very polarizing individual, but people love to underestimate him, and he's tended to prove most people wrong. Does he have quirks? Absolutely. We don't have to go into those. But the point is, his achievements, continue to surprise even his worst naysayers. When you look at the Gulf and you look at oil and you look at a country that's being devastated like Iran, yes, they're fighting for their lives. On the other hand, there's only so long that they can go on because they need those petroleum dollars and they're losing leaders. So hopefully this conflict is solved in the next few weeks. That, it doesn't seem to be protracted like the way Ukraine was. This seems to be vigorously enforced. But when it comes to growth, I think over time, and obviously you can speak to economists and market strategists, global issues and wars tend to not really impact, the US economy, right? It would have to be protracted for a long time. The fact that we are a net exporter of oil, right? If you look at the delta between West Texas, WTI and Brent, it shows you the advantage of having a very productive domestic energy solution. We didn't have that in 1979. We didn't have that in 73, right? When you have the countries that are hurt most by the closure of the straits are the countries currently that don't want to pitch in to help. That eventually is going to come to a head because Europe and Asia need those straits open, right? So everyone is assuming, $200-300 barrel of oil. Maybe that will happen. I'm not saying it won't. I'm not an oil guy. But no one is really pricing in the fact that this could be resolved in the next few weeks. And that is a game changer that if you have a portfolio, you have to ask yourself, do you own anything that is priced to go up? And, again, I go back to office. If you look at, SL Green, yeah, it has nothing to do with the Straits of Hormuz, but it has high beta and certainly would benefit hugely in a market rally. So, again, people tend to think of the extreme, and the reality is often different, but reality is a soothing construct because if you look at the field today, while Europe and Asia have indicated they don't want to help, they are the countries that most need those straits open. And you have to ask yourself, how long is that going to persist?
Okay. You briefly mentioned SL Green, and thank you for rehashing what's going on. But I'm guessing, what is the REIT sector outlook for the rest of the year?
So I think a lot of it's going to come to jobs, right? Certainly apartments need jobs. If you end up with, more months of job losses, the what was it, the February anomaly is no longer an anomaly. Already the outlook for apartments this year was pretty tepid. The management teams were subdued heading in out of the fourth quarter earnings with their outlooks because of new rent growth not looking great and them banking on renewals. Retail has proven incredibly durable. Again, go back to the lack of supply and the fact that pre-pandemic, a lot of the brands were focused on the internet, on their online strategy, to the detriment of their store fleets. They're now catching up. And the fact that you have no new supply means that they know that if they pass up a location, they're not getting another, hard to get another crack at the apple. So I think retail is pretty secure. Everyone loves to bet against the American consumer. It's been a losing trade for decades. I'm not going to say one day that, that shit won't get cashed, but, it does look pretty good. And certainly gasoline as a percent of people's income and expenditures has declined precipitously from where it was, in the 70s, late early 80s. Industrial, again, assuming that businesses don't all shut down, right? I don't see why they would. The demand for industrial should continue to grow. Certainly, the pullback in supply has been good. Yes, there's still some issues around the ports. Yes, there was some overbuilding in the broader LA market, but in general, industrial is getting on. And again, lack of supply is huge. I can't speak to senior housing. I don't cover it, but obviously, you highlighted Janus. It's playing into that whole theme. Data centers, the demand for AI, it comes down to power and location, but certainly we're using more data, not less. And when you look at the malls, Simon has clearly shown itself to be a leader. But even if you look at what Macerich is doing, they're doing things now that should have been done, a decade or two ago. Unfortunately, it took a new management team to implement, but what Jackson and Dan are doing is good. It just takes a while because there's a lot to take care of. No different than if you bought a house that hadn't been renovated in a long time. There's a lot of work that needs to be done. They're doing it. But certainly the mall has shown that dominant malls are surviving, and even some of the lesser malls, because of no new supply, are getting new life. So that's, sort of it. I think I covered most of the major areas, and especially focusing more on the sectors that we cover. But in general, this lack of supply and the fact that market rents are exceeding in-place rents, so you're getting that upward bias, that's a pretty good thing. And again, inflation has come down. So the OpEx pressures come down, insurance pressures come down. A lot of these things have come down. And that means that any amount of rent growth really is falling to the bottom line.
Well, obviously, as I like to joke, I have no control over my ETF stock price. I have no control over my constituent stock price. All I can control is the story. And when I chat with advisors and investors, I say, look, when you buy REITs, anything that happens with stock price appreciation is the extra cherry on top of the sundae. When I focus on REITs personally, I think about the dividend side of the equation.
Yes.
So give me your thoughts potentially about dividend growth for our sector this year and beyond.
So, for a long time, and I think even to this day, dividends don't get the respect they deserve. Clearly, any study of long-term total returns shows the importance of dividends. But it's interesting. We look back at REIT total returns in the dot-com era versus today. And while REITs on a price only basis really underperformed heading into the dot-com, on a total return basis, they actually were pretty competitive with the market. This time around, price only into the beginning of this year, price only and total return were not good. And in part because dividends haven't really grown. And yes, in the 90s, dividends were much higher than they should have been. But, for managements, a company like Federal or Essex or Simon really lead with their dividend and their track record. But more companies need to do that. And ultimately, it's one of the reasons I don't like same store NOI. And you see in our research, we tend to be focused more on the total earnings picture. Ultimately, real estate is about cash flow growth. And if you have a story where the earnings and the dividend are going up and to the right, the balance sheet is flat to improving, I don't care what the management is doing or what business they are, it's working, right? And we need those dividends to grow. I think management teams this year are starting to get it. And I think for that, it's a very good thing in the sense of dividends drive total return. So as earnings grow, I would expect to see that fall to the bottom line as far as increased payouts. Is it 1-to-1? I don't know. But I think the management teams realize that they need to really demonstrate cash flow growth, and the best way to do that is dividends.
I would ask you for your takeaways from fourth quarter earnings, and I'd like maybe a quick little recap there. But now, frankly, we're closer to first quarter earnings season than we are from fourth quarter. So maybe let's recap and review and a look ahead to what's potentially coming down the road.
Sure. And I'm just looking at my dividend yield right now. I mean, for way back when in the way back machine, REIT dividend yields were ahead of the 10-year. Now they're at or below. We haven't published our first quarter earnings outlook preview, so I don't want to get ahead of myself. But as we sit here today, the themes of the fourth quarter remain true, right? For apartments, it's focused on jobs. For office, it's focused on leasing and AI disruption. For retail, it's focused on credit. For industrial, it's just focused on the general economy. So I don't think any of those themes have changed. Certainly you're going to get a lot more attention on anything involving Iran. So I'm sure that Rick and Keith at Camden will get they'll be the oil experts in REIT land, because that's I don't know if anyone knows, but Camden is as much an oil stock as it is an apartment stock, because Rick and Keith know all the oil, all the wildcatters in Houston. The West Coast names and New York names are going to be peppered with AI and what's going on with space. New York and California will again be peppered with politics, right? Whether it's the governor's race in California, the mayoral race in LA, or what's going on with the same thing here, the governor race in New York, Mondani, in the city. Those will remain dominant themes. And that is, again, like a lot of things in the market today, it's the macro. But again, I go back to lack of supply, and that is such a huge positive that doesn't really get the same recognition that it should. But it's really the reason why the REITs are generating the earnings they are, and it's the reason why you're seeing those occupancies, continue to recover from the COVID lows.
And a year ago, right around this time, it was all tariff talk. That was what dominated first quarter earnings season calls was Liberation Day and the impact of tariffs going forward. So it seems like, as you said earlier, rinse repeat. New year, new story, new thing that's going to disrupt earnings, and management teams conveying that my job's to put on the blinders and focus on fundamentals. How do I grow revenues, cut expenses, maximize NOI growth to push out dividends? I feel like that's the mantra for a lot of these executives that are out there. All right. So one of your names got acquired last week. The Blackstone Alexander Baldwin deal closed.
Yes.
We've got Elm Communities, Center Space, Aimco, Plymouth, We've seen the M&A machine humming along, or companies exploring strategic alternatives, as they like to say. What do you think about REIT M&A this year and beyond? Do you think we see a big pickup in activity? Is it going to be rate driven? Because obviously, money stock right now is very hard to do unless your name is Welltower or Public Storage or some of these other guys. So, what's your thoughts about M&A going forward?
I have to give a shout out to Shank. I don't cover Welltower. I remember him as a client. God bless what he has created there and done. Amazing, right? Uh, M&A will absolutely continue. The demand, that imbalance between in-place rents versus market rents, when you look at lack of supply and the fact that the credit markets are open, are competitive, hugely attractive for the Blackstones of the world and the alternative managers. The private credit situation and focus changes the narrative a bit. At the beginning of the year, I used to throw Blue Owl into that mix as an example. We'll see what happens with private credit. Is it, a much bigger unraveling phenomena, or is it something that's contained? If it's contained, then I think you'll see a number of those funds that had some private credit concerns start to re-engage. If it grows wider, then yeah, it's going to affect M&A by definition. But the privatization of REITs will continue because the disconnect between where a lot of the companies are trading versus that lack of supply narrative. And think about this. Usually when private equity underwrites a call it 5 to 7 year hold, they never underwrite a recession or competitive supply, but usually that comes up. Right now, you can honestly underwrite a lack of supply. You still don't know about recession, but you can underwrite a lack of supply. That gives you a lot more confidence in your ability to compete and make a bid. That's a game changer. That's huge.
Yeah, I'd like to also point out that for the REIT folks, we were just in this position in the past couple of years with the non-traded REITs, gating redemptions, investors having issues, valuations, and it carried over to the public REIT side of the equation. So, I feel like it's just a new day, new story that somehow overhangs our sector. And again, it's on these management teams to say, look, this is how we're different. But, as I like to joke, this isn't our first rodeo. So, all right, let's
I
turn
think,
it more to you.
hold on, David,
Talk to us.
just one thing there, and this is really critical. I think you're starting to see REITs do this, but REITs do themselves a huge disservice when they don't appreciate how much of an impact it is when you take properties offline, when you sell large amounts of assets and you reset earnings down. That's a bigger impact than any price of oil, any tariff, any macro concern, right? Because public investors want earnings that grow up and to the right. They want dividends that grow up and to the right. Telling people that we're going to improve NAV or we're going to create this new project that's going to be amazing, it doesn't mean anything if you don't have the earnings growth to support that. And I think you've seen that especially in office like Boston Properties, where they're getting it. They're understanding we can't do all these developments. We got to monetize land that we have. We got to scale back what we're working on. You've seen Avalon Bay reduce their development program to get it more right sized. And I think the companies are getting a better handle because the capital cost has increased, but also because they realize the earnings impact when you take buildings offline to redevelop them. That may be great in the future, but for PMs who need to compete today, it doesn't help. You need earnings. And I think that's a big topic that doesn't get appreciated, but I think managements are getting it, that as part of the dividend story that you asked about before, it comes down to management's decisions on how they lease, the timing of when that revenue is recognized, and how they think about, either capital spends or dispositions vis-a-vis, is it going to be disruptive to the company?
Talk to us about how you do your research. What is Piper's approach to REIT research? What makes you guys unique?
So Piper has a number of good qualities that parallel with what I had at Sandler, which is the analysts are left alone. There's no overarching like house view. Obviously, we have some phenomenal people. I mean, Cantro and Nancy Lazar, two of the best, but we're not mandated to follow one point of view, and I think that's good. Uh, the second is, and not surprisingly for people who engage with us, and one for all you who do, we really appreciate your business. But we're a thin team, not physically. I wish physically that was the case, but from a headcount perspective, I've always been a team of two. Sometimes I've had an additional associate, but my colleague Connor and I, and he hustles hard, great guy. But we're like the old Avis ad. We do, we try harder, we do more with less. And that's just how we run our business. But I think what people appreciate about us is one, our management relations, our deep knowledge of the sectors that we cover, and the fact that we're not a quarter to quarter thinking research shop. Like, we're thinking about the next 12, 18 months. We're thinking about the political environment. We're thinking about how all the different macro themes come into it. My first boss at Lehman, David Schulman, was strategist at Solomon Brothers back in the 80s. And he ingrained in us that real estate is a derivative of credit in the economy. So when you read our research, you're always going to see references to what's going on with the economy, what's going on with interest rates. And that's just something that is core to us, and it's evident in our research. And that's fun. I do enjoy writing. It's awesome. I love the movie quotes. But we try to focus on what driving the story over time. But I have to say, there are a lot of great competitors out there. I think all the REIT sell-siders, I think we all do a really good job. I hope we do. But we each have our niches. And I think for the clients, the fact that each of us is good at different parts helps them do their job better, because they can know they can call Piper for one area, call another shop for other areas, and it helps with their mosaic. And ultimately, we're all part of REIT land. We want to see this industry thrive. We get frustrated when it underperforms. We get excited when it does well. And we're all here to move that ball down the field.
I want to ask an adjacent question because, as far as I know, you're the only REIT analyst that covers guys like Alexander's, Howard Hughes, Innovative Industrial. Um, a couple of the guys cover the brokerage firms, or like the CB, Richard Ellis, JLLs, Newmarks. If I recall, you said Newmark was one of your top picks on your CNBC interview. So why Alexander's? Why Triple H, not the wrestler? Why Invitation IIPR?
So, Howard Hughes, David O'Reilly, the CEO, he and I worked together at Lehman. So I have, when he went to the company side, I covered him at Parkway, and then he went to Howard Hughes, and he's just an amazing individual. He's been a great executive, and I just really enjoyed working with him. And I like the way he runs companies and really fine tunes them. And it's been a really interesting story. And obviously, with Ackman re-engaging and wanting to transform it into a mini Berkshire, I mean, we just hosted Bill and his CIO, Ryan Israel. It's phenomenal. It's fascinating. I mean, talk about something that's not, hey, how are new rents looking this quarter? It's
Let me pause you there. That means you're going to hook me up with Bill Ackman to do one of these REIT webinars, right?
uh I'm not going to promise on air, because I do like to deliver on my word. But I have
Love
to
it.
say,
Okay.
Bill is a great guy. And we haven't always been favorable to what he's been trying to do, and he's called us out on it. But as I recall, one time we ended up with a 45-minute conversation, with me telling him, the issues with Howard Hughes, right? It was pretty cool. So that's it on that. Alexander's, one, obviously the name, but two, when I launched coverage on Vornado, when I joined Sandler back in 2009, I just felt like Alexander's is the forgotten, little sister to Vornado. And, when you look at how much of Alexander's that Steve Roth and his interstate partners own of it, you realize that it's a special company. And I've enjoyed covering it. It's fascinating. It's small enough that you can actually look at individual assets. I mean, they're only they keep selling them off, and now you're basically down to two, three, I guess, actually, with the apartments. But it's a fascinating story. You mentioned, who else did you mention? Newmark. We were on their
Innovative.
IPO. Barry Gosin, the head of Newmark. I actually had done a CNBC bit with him back in the like 2010, something around there. It was the first time I met
You
him.
were clean shaven back then. I
I
saw
was,
the video.
I was, but and we were upstairs at the exchange. But Barry he's a broker's broker. I mean, he's phenomenal. Innovative Industrial. I am not a user. I am not a partaker. So I purely cover it, as an analyst. My former colleague had picked him up, and when he left, I had a decision to make: do I want to keep it or not? And I'm like, you know what? I don't partake of the product, but certainly it's a fun sector, if you will. And it's fascinating to me because there are a lot of legal consequences. And that aspect is really interesting. When you think about an industry like the booze business, right? There's no more bathtub gin. There's no, I mean, to make a fish reference, bathtub gin. There's no, moonshine. But cannabis, you have a huge dominant black market. You have a gray market, right? You have, legal stuff that's sold illegally across state lines. You have people who still have their guy, right? And then you have overcapacity. Like there's a lot of interesting stuff. And I have to say, despite our rating on the stock, we've been underweight. You know, Paul Smithers, Dave Smith, Cat, like they're really I have a huge amount of respect, especially Paul, because of all the legal stuff they've gone through and his background as a lawyer, like with all these tenants that are trying to stiff him on rent. I mean, this isn't, Goodfellas and a baseball bat to crack heads. This is, a pen and a legal filing to, crack wallets, if you will. But it's really fascinating. I think they're in a tough spot. I think they're very good. I'm not a fan of the IQHQ. We've been clear about that in our research. We aren't just view that as really risky. But it's been a very interesting story to cover.
Uh, Props on the bathtub gin mentioned there. Very
No
well
problem.
done.
And to be
All right.
clear, because I did say it's negative, but I spoke highly of management. Again, our negative thesis is there's way too much capacity. There's overinvestment in cannabis. Believe it or not, people get too wide-eyed, if you will, about what the upside is. And there's just more consolidation needs to happen. The fact they continue to have bankruptcy issues that pop up really serves as a testament. And again, investing in a private development life science company is just an added risk that I don't think is necessary.
So besides your kids' schedules and what's going on down the street at MSG on a nightly basis, what keeps you up at night these days?
So, as most people know, I'm not a sports guy. Politics is my sport. So, come election night, I'm glued to the TV. I get anxious following what goes on in Congress and elections. So, that's my sport. Uh, what keeps me up at night? For a while, it was heartburn. I love Pepto, so it's good stuff. It works. Uh, but I think what keeps me up at night is there's an adage I developed over the past few years. Never trust advice from anyone who doesn't pump their own gas. When you see people on TV, and I say TV generically, it could be social media, whatever, making prognostications about the economy or the country or the consumer. And you realize that that person probably has not pumped their own gas in years, or if they do, they're indifferent whether they pay 30 cents more over here or 20 cents more over there. It shows you there's a detachment. And ultimately, it's like what bothers me in apartments is when people say, oh, incomes are up, renters can pay more in rent. Maybe they can, but they don't want to. And the inflation over the past 5 years, the 25%, 30% aggregate inflation, has, I think, affected people a lot more than I think some of the talking heads want to admit or realize. And I think if you said, hey, what is the biggest risk to REITs, especially apartments going forward? It's not appreciating that people are very protective over the dollars that they've earned. And maybe they can well afford what it is that, the apartment or the whatever it is, the product that's being offered. The question is, do they want to spend their money there? And that bothers me in the sense that people like to go to extremes. All white collar jobs are going to be eliminated. Oil's just going to three, like all these crazy concepts. Maybe those are true, but there's also reality. And I like living in reality, but it does cause, some sleepless nights because you hear these negative doomers on the TV or in the internet. And it's like, guys, what happened to optimism? What happened to, people figure it out, right? And unfortunately, that's the dialogue of our political scheme these days. But ultimately, if you look back, especially in America, we're pretty resilient. We tend to come out better, not worse. And if you look at reality on the ground, COVID ended up being a blessing, not because there was a tragic loss of life that is, upsetting, should not have happened. But the lessons that people learned, the fact that you had people coming out thinking more about their families, thinking more about where they live, thinking more about their lifestyle, that's pretty remarkable. And I think it reset a lot of people to think more holistically about how they want to conduct themselves and how they want to raise their families and how they want to spend time. That's amazing.
You can almost say the exact same thing about 9/11 as well, from where you're sitting, because that changed a lot of stuff in that landscape as well. Where people work, where people live, commuting, all these different things that kind of had a trickle down effect from that incident as well. So um,
Yeah, and I think,
I see
I
from
was
the
there. I started my Wall Street career. I was at 3 World 5 that day. I think the biggest change that 9/11 had is before everyone would always downplay anything that happened. Like, don't get involved. Don't believe it. Now people are much more in tune. You get a crazy guy on a plane who gets up to like barge the cockpit. Everyone on that plane is going after that guy. There's smoke in a building. There's something that goes on. People are not sitting at their desk going, "Hey, I don't need to worry about it."
And you had a big fire at a building this week, if I recall, in Midtown, like on the roof of one of the buildings. I saw some of the headlines and some of the posts on social were like, "Haven't seen this in a long time. Don't want to see it again." So, I get it. All right. I remember sitting with you at an Essex meeting at NAREIT a couple of years ago, and you had put out a note at the time. I'm going somewhere with this. You had put out a note at the time that, hey, West Coast apartment guys, aren't you a little bit concerned about all of these EVs that are out there? And God forbid an EV catches fire, a battery fire happens in one of your parking garages. And, it kind of sent the snowball going down the mountain. So that's a very unique topic that, I've never forgotten that because you kind of think outside the box. So along that same line, and I know we've covered a lot of stuff here, what's something unique that REIT investors should be thinking about today that we haven't already covered?
Well, I mean, the EVs, especially with how much focus there was on electrifying all cars, I don't think anyone ever realized one, the fire issues, the fire suppression issues, two, the weight. Like that buildings and garages and bridges are not built for the weight of EV cars and trucks. But especially the fact that EV fires burn hotter than the Twin Towers did, and they can't really be put out by traditional means. That was very concerning. And I thought that was something that when you have people living upstairs, is scary. And that's why we brought it up. Today, my concern is more on the other side. I just don't think people really appreciate this lack of supply. Uh, but if you said economically, yeah, the political landscape is very concerning. If you look here in New York, our energy policy is, quickly coming to a head. You can see it in the political discussion. And when you have a state next door like Pennsylvania that has a huge amount of energy and is much more moderate political climate, it's concerning for New York, right? When you look at housing in New York, what we are doing to the million regulated units is just destructive. And people don't appreciate that the 2024 rent laws will do the same to a chunk of apartments built between 1974 and 2009. Those are things that are like, this is not good. California obviously has its own issues. you know, but the political issues, the tax issues, these aren't going away. And if you look at Virginia, yes, Virginia's been Democrat for a number of decades, but today's Democrats are much more leftist than they were before. And so Virginia doesn't have the scar tissue that New York and California voters do. So they're only now going down that path with Spamberger. Are defense contractors going to remain in Northern Virginia? Absolutely. But for other aspects of the state, it's an experiment that's happening real time. Uh, at the same point, there's a lot of things that are great, and San Francisco has really shown, and even New York has shown that, as much as we want to write off certain geographies, there's a resilience, and that's something that we always have to remember. I was one of the people who said, "Oh, New York's never come back. Like it's down and out." It surprised tremendously. San Francisco the same way. Oh, who wants San Francisco? Exit San Francisco. What happened? They got a new mayor and they changed, they moved that pendulum. Now, it's not Texas moderate, but it's California moderate. And the new mayor has done a phenomenal job. The tech innovation hub of San Francisco is phenomenal, right? And I think as people move forward, you realize it's not about abandoning areas, it's about where you invest. So San Francisco has reestablished itself. We'll see what happens in Washington with this income tax. But for right now, you probably want to be on the east side in Bellevue, not in Seattle, just given the political difference. In New York is amazingly vibrant. I don't think Mondani and Hochul are going to kill the city. Yes, taxes are going up some, but probably not enough that it causes people to flee. Would anyone be surprised if Hochul raises taxes after the election? No, people expect that. But, the fact that she's out asking the Palm Beach crowd to come back home tells you they realize that they can't scare the tax dollars they need. And office in Midtown is a core part of that economic engine for the state. So I don't think they're going to kill it. My point is, it goes back to reality. It goes back to trying to maintain an even keel and understand, even as much as you may love a geography or hate a political, viewpoint, there's always, you got to keep it sober. You gotta keep an even view and look on both sides and figure out like, okay, what is going forward. If you look at energy, I think that is critical. And, being located in areas that have sufficient power plants is critical. Here in New York, it's a big issue. We closed down Indian Point. That was a dumb decision then. It's even dumber today. That was 25% of downstate power, clean, efficient, carbon free, and had already been paid for 40 or 50 years ago. That's something that we're paying for now. And if you're a real estate investor, you have to think about your energy costs, right? And unfortunately, California and New York do not make it easy in that regard. And eventually, that's something, if it's not addressed, we do need more natural gas. We need more nuclear. And to some degree, we need coal. It's pretty reliable, it's inexpensive. But, you need all forms. You can't just only rely on windmills and solar panels. But, that's longer term, but it's interesting how it's quickly coming home to roost if you read the local political discussions.
Well, I got a couple more wrap-up questions here for you. And I don't want you to mention the lack of supply story because I know we've talked about that a lot here. But besides the lack of supply story, what is the value proposition to invest in REITs this year and beyond?
So the value proposition is earnings growth that's, pick your sector, call it 3 to 4%. Maybe it's, in industrials, it's probably in the 5, 6, maybe 7. You have dividend yields at around 4%. So all things equal, you are looking at a, 7 to 8% total return story. That's pretty attractive. When you looked at the valuation disconnect versus the broader market heading into this year, it was pretty wide. Again, valuation is not enough to ever get something going in and of itself. But if people were looking for other areas in the market that hadn't run as hard as NVIDIA, for example, REITs definitely jumped out. when you look at the religion the management teams are getting as far as, hey, we need to be better capital allocators. I mean, look at apartments. So many of the companies are buying back stock. They're paring back development. When you look at office, they're paring back development. They're jettisoning, development sites. When you look at industrials, they can really quickly throttle up, throttle back development. And when you look at retail, they've really proven that this credit environment is really advantageous for them. And they've also been good at walking people back. And I forget if it was, I always think it's Stacy Slater at Bricks who started the S&O. Maybe it is, maybe it's not, but she's a great woman, so I'll give her credit for it. But, the REITs have been really clear of, hey, S&O is out there, but do not just 100% layer it in. It's just incremental on the upside, but it has to be viewed in total context. And I think the companies have done a good job of that to try and get people thinking about where growth is going. But that steady upward movement of occupancy and rents is visible. You're seeing it, and you saw it this year. I mean, Don Wood and Connor Flynn both came out with solid guidance, blew out the street. Really surprised me, especially Connor. It was great. And those incremental changes is what the industry needs. And I think collectively you roll it all together. And that's why, so far REITs have been outperforming the broader market. And that's, certainly we didn't expect that at the beginning of the year. We'd been overweight on the sector for a number of years. And finally, I'm like, yeah, the heck with it. I went neutral because how many years can you be burned? Well, thankfully this year I'm being burned the right way. You know what I mean? And, hopefully it continues. But, as I say, I won't mention the theme, but you wrap it all together and this enchilada is tasting pretty good.
For somebody who's new to the space that doesn't know REITs the way that we do, if you could offer one piece of REIT investing advice to that person, what would you say?
If it doesn't pencil on a wet cocktail napkin, don't do it. Real estate is a simple business. If you overcomplexify it, you have to add in all the bells and whistles, fee income and everything. Not a good thing. Simplicity.
I like that. Let me give you an adjacent question. If you could go back and talk to Alex Lehman Brothers day one, what would you tell that person from where you sit today?
Don't go spending all that money on Paul Stewart suits and Hermes ties. Not worth it. Uh, you know, that's something that COVID taught, and I think I'm not alone in saying that a lot of my wardrobe shrank. I don't know how it is, but all those clothes when they just sit in the closet, not being worn every day, they shrink in size. But I think that's the biggest takeaway. The other thing is, and this is just someone of my generation, uh, be a believer in the market. Don't be scared of the market. The problem is that for those of us who came about ahead of the dot-com, watched the market go up and then blew up, and then housing, GFC blows up again, there's a fear of the market. And I think over time the market has done well and it's been a great source of wealth generation. Not each and every cycle, but over time, yes. And I, having experienced two big blowups early in my career, definitely gave a sense of hesitancy on a personal front. And ironically, it wasn't until COVID that I got enthusiastic. So that's probably another big lesson is don't be so fearful.
I'm happy to send you my address. You could send me some of those Hermes ties that are collecting dust in your closet if you're looking to get rid of some of those. But in all seriousness, Alex, I really appreciate the past hour. You've shared a lot of great insight and knowledge from us. And again, I mean, I know I, laughed about it, but clearly it does seem that this lack of supply should be some of these tailwinds or green shoots that we need to hopefully push us forward the rest of the year. But on behalf of the entire audience and for anybody that's watching this down the road, I can't thank you enough. I think we have a question here. Go ahead, Willie. Uh, let's
I
see.
was just clapping for you. Thank you very much. I appreciate everything.
Thank you. Thank
Thank
you for
you.
coming on. And I want to say one, thank you, Dave, for making time and hosting us. thank you everyone out there, especially those of you who are clients and work with us here at Piper Sandler. And for those of you who don't, obviously we'd welcome a chance to demonstrate our skills. Feel free to reach out, but really appreciate the time.
Thanks again, Alex. We really appreciate it.